The presentation and disclosure requirements in ASC 842 are much more comprehensive than those required before. Don't underestimate the amount of effort involved in this final step. Lessees are required to disclose certain financial statement presentations under the ASC 842. Hi, I'm Priya Singleton, Quality Control Officer at Blue & Company, and I'm going to share an overview of the presentation and disclosure requirements under the new lease standard. On the balance sheet, the right-of-use assets and lease liabilities must be presented by lease classification, operating versus finance, on a gross basis and on separate line items from one another, either on the face of the financial statements or in the notes. Each of the following must be recorded by the lessee in separate balance sheet line items: finance lease right-of-use assets, operating lease right-of-use assets, finance lease liabilities, and operating lease liabilities. A lessee may decide to include these line items as a subcategory of a larger balance sheet classification, like property, plant, and equipment. If a lessee discloses those amounts in the notes, it should also disclose in which line items the amounts are included in the balance sheet. If a lessee does not elect the short-term lease exemption, the right-of-use asset for a lease with terms of 12 months or less should be classified as current. All other right-of-use assets should be presented as non-current assets in a classified balance sheet, similar to other amortizable assets. Lease liabilities should be classified as current or non-current, similar to other financial liabilities. Companies should evaluate the impact of these liabilities on their debt covenant measures, such as the current ratio, when implementing the new lease accounting guidance. On the income statement, interest on finance leases is presented in the non-operating section of the income statement, consistent with other interest expenses. Amortization of the finance lease right-of-use asset is presented as a component of operating income and in a manner consistent with similar items like depreciation or amortization. Both the interest and amortization expense would be added back to earnings when calculating EBITDA. For operating leases, a single lease expense, which would be rent expense, is presented as a component of income or loss from operations. On the statement of cash flows, cash payments for the principal portion of the lease liability from finance lease are shown as cash outflows from financing activities. Lessees should present all other lease-related cash payments or receipts, such as short-term lease payments or variable payments not included in the lease liability, within cash flows from operating activities, regardless of whether they're associated with finance or operating leases. Cash flows associated with bringing an asset to the condition and location necessary for its intended use should continue to be classified as an investing activity. ASC 842 requires some new footnote disclosure requirements while retaining some of the previously required disclosures. The overall disclosure objective for lessees is to provide information that enables users of the financial statements to assess the effects leases have on the amount, timing, and uncertainty of cash flows. These disclosures include quantitative and qualitative information about the lease contracts, significant judgments made in applying ASC 842, and amounts recognized in the financial statements, among many others. If you'd like to see an example of a lessee's disclosure, click on the link below and download Blue & Company's ASC 842 Lessee Implementation Guide.